Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some quick stock analysis for GE Vernova. I wish I would have found this stock sooner because this would have been a pretty solid stock pick for the past 12 months. 12 months ago, this stock was under $300. Now, this stock is over $800, and it recently hit over $900. And it really wouldn't have been that risky of a pick because this is a GE spinoff. If you don't know, they went public roughly 2 years ago. Around this time, 2 years ago, they went public at $115 a share. Now it's around $900 a share. And this is pretty much the aspects. This business is for the electric power industry, and they operate through power, wind, and electrification. Okay, it's a $229 billion market cap, and we're going to do some stock analysis to see is this stock a buy still, or is it something that needs to get cheaper before we buy it? What's the deal here? Well, the revenue the past couple of years really has been flat at around 35 to 40 billion dollars. It's not really growing much. But net income and free cash flow have definitely gotten better. Trailing 12 months, we've seen 4.8 billion in net income and then 3.7 billion in free cash flow. The cash on the balance sheet is $8.8 billion with no debt, which is phenomenal. They've been increasing their dividend. Shares outstanding is roughly flat. We come over here to ratios. We can see profit margin skyrocketed past this last quarter to 33%. Their return on capital employed is 12.8%. Come over here to valuation, and we could see that the PE is kind of just hanging out. I mean, 50 times earnings is not cheap. But it's kind of just where it usually hangs out at, so it's nothing too crazy. Free cash flow yield is lower than normal. It's only 1.4%. That's not very good. Price to sales, super high. This is the highest it's been since it went IPO. Price to sales of 6. So just by looking at those metrics, this is not a good time to buy the stock. Just because it's already gone up so much. There's already been so much money put into this stock, and their numbers have gotten better, but I mean, like revenue is basically flat. And if we look at what they're going to do for numbers, they're supposed to grow 17% this year to 44 billion, which is definitely respectable growth. That's still a solid amount. But I don't know, with the price of sales being at an all-time high, I wouldn't buy it right now. Then it's supposed to go down to 13%. Gap EPS is actually supposed to go down this year to only $14 and then go back up to $22, which is also that's a pretty solid number. So let's see what Gemini has to say about this stock. Well, GE Vernova's moat is built on scale and high switching costs. Their technology generates approximately 25 to 30% of the world's electricity. That's incredible, right? That's a huge amount. They have a huge moat there. With over 7,000 gas turbines and 55,000 wind turbines, they have a massive recurring revenue stream from these services, which accounted for 45% of revenue last year. They are the pick and shovels of the AI boom, which this is probably why the stock has gone up. This is the big thing. Hyperscalers cannot run AI without 24/7 power, and the GEV is the market leader in high efficiency gas turbines and electrification hardware. Required to connect data centers to the grid, they entered this year with a $150 billion backlog, which is crazy. Management has sold out turbine capacity through 2028, providing nearly guaranteed revenue for the next 2 to 3 years. The stock's recent $800 price point is supported by the earnings explosion, where they reported $13 versus the $3 expected, fueled by a 2.9 tax benefit release, which is what let's go back here to EPS and see what normalized. Okay, so it's actually, let's see, it's actually pretty similar. It's almost the same thing. Then management has doubled the dividend. They have increased share buyback to $10 billion. So everything's heading in the right direction. Again, if you would have bought this stock anytime before 2026, it would have been a fantastic pick, and it wouldn't have been some, like risky stock to bet on. This is a GE company. So for the next year or so, we're looking at price targets on an average of about $850, which means it's probably going to stay flat, or it's going to be about the same price at the end of the year. Long term, 3 year projections of $1,700, and then right now and going into next year, we're looking at $1,100 is the top one. So then let's go over to ChatGPT. GE Vernova is basically the power and grid and wind company spun out of GE in 24. Okay. So they have power with gas turbines, huge profit driver, electrification, grid equipment, wind, struggling but improving. Okay. The bull case AI equals massive electricity demand. Data centers and AI require insane power, and GE Vernova sells the gas turbines and grid infrastructure. Orders are and backlog are booming. So, kind of like how you see the same thing with Mike. This company is pretty much the same thing that's going on with Micron and some of these other companies that are also experiencing that huge demand like a Oracle or something. Well, Oracle in this case is actually they have the backlog, but their stock has been destroyed. So huge backlog equals visibility of $150 plus predictable revenue. Okay, I mean, how come that's not happening for a company like Oracle then when they have a bunch of backlog too? Management expects EBITDA to more than double. Margins are expected to expand significantly. High margin services flywheel. Once turbines are installed, recurring service revenue. This is the hidden gold mine. Installed base moat. Thousands of turbines already deployed globally. Customers rely on GE for maintenance, upgrades, and parts. Great. And again, so they have a moat. They have good numbers and everything. The problem is just evaluation. So really, what we have to do is let's go back here real quick. Their PEG ratio is also expensive. You can that shows you how expensive it is. It's at a 3.3. It's because they're not growing. I mean, they are growing, but I mean, they have to realize all that money in the backlog. So that 150, if they have 150 billion in backlog, is that going to take them a decade to realize that, or what does that look like? Then, I mean, the P ratio is high, the four P is high, PEG is high, price to sales is high. So I would really want to be paying maybe I don't know. I mean, I don't like paying more. I mean, it depends on the company, but for a company like this, maybe 30 times, 35 times earnings. I would say like 30 times earnings. So like I'm looking at this like let's say if they're gonna do let's say they're doing somewhere around 20 $22 EPS next year. I'm gonna say I feel like the stock should be like maybe 650, 700, something like that. That's where I see the stock. That's where it deserves the trade. Right now, I think it's run up a little bit too much. I think they also just got added to the S&P 100 fund, so that's definitely, inflating the stock as well. But I think this stock is probably going to come back down. Again, look how long it hung out at this $600 range. So that's probably where it's going to fall, especially if we have if this market keeps crashing. I think this is especially where it's going to fall back to. It's going to fall back to this $600 range. Um, and then at that point, I would say it's probably a fair valuation. It's not even really a buy. For it to be a buy, it probably would have to come more down to like 450 or something. But that's kind of where I see it. If you well, let me know what you guys think down below, and I will see you in the next video.